Hello and welcome to With Wellner Anderson. This is our monthly update for those of you who have not subscribed. If you want to get the data on what's going on in the economy and things that are going on in your life economically, you need to subscribe, you need to like, and those of you who have been with me for a while, I thank you. Let me tell you one thing, the best investment you can make is in yourself. But what we're going to be talking about today is just the general update on the economy. This is our fifth one, and the date is Tuesday, November 29th. Okay, we are in recession. Technical recession. Despite what the talking heads say, the definition of recession is 2 successive months of lost domestic product. So, what is gross domestic product or lost gross domestic product? Domestic product is the annual amount of finished goods provided by a nation, less its imports. That gives you a measure on how well your economy is going. Okay. So, what are the signs of recession? Low interest rates, credit tightening, unemployment rises, not happening. It's slowly happening. On this Friday, you should have a report on the latest unemployment rates. Slow growth in housing, prices continue to rise. We're actually in recession in stagflation, which we did the video on. Prices actually dropped, but in any case, there are more renters than buyers. Credit costs increase. Part-time workers increase. Corporate downsizing. The market drops. Bond rates rise. And there could be deflation. And I said, we are in the recession. We've been in recession for now about 2 to 3 months. And, well, what does that mean to you? What are the tools that you hear every day that can help you better understand what these people are talking about? We're going to talk about some economic tools, but let's start off first with what a central bank is, because they're sort of in the middle of this. And in the United States, it's called the Federal Reserve. And they play a critical role in the monetary rationale. You know, let's spare that for a moment. Let's go back to the tools that you hear about that give you some indication on what's happening with the market. There's something called the federal funds rate. Now, the federal funds rate is the rate the bank charges its best customer. And the best customer of a bank is another bank. To give you an idea of what I mean is at the end of the day, the banks have to have a certain amount of money in their vaults to cover the people who may come in and ask for the money in the morning. Now, in the vaults, I'm being literal. I mean, I'm not being literal. I'm saying the vaults could be electronic or whatever. They must have a certain percentage of cash on hand. What happens is a bank will lend another bank that money overnight to make sure that they have the reserves. And that is the best possible rate you can get for a loan, because it's a bank lending to a bank. If you can think of it this way, if that didn't happen, if you've ever seen the 1947 movie It's a Wonderful Life, there's a bank run where George Bailey, the banker, doesn't have enough money to service his clients. That's why the federal funds rate occurs. Again, to have money to open your bank the next day. If you think of the federal funds rate, there's a prime rate, which is the rate that banks charge their best customers other than banks, and that's usually 3 points above the federal funds rate. But the federal funds rate has been steadily going up, and what that means is that it's going to cycle through the economy, and other rates continue to climb. Let's talk a little bit about the Federal Reserve System and central banks. I promise you I talk about that. The job of central banks are pretty general. Manage the money supply, manage the banking system to making sure that the system is fair and legal. They set the interest rates through the Federal Open Markets Committee. They meet every 6 weeks. And they set the federal funds rate, as I said to you before. The federal funds rate has gone up lately. It's now at 3.75 to 4. Another tool that economists use when they look at the economy is they use the stock markets. And we're going to use the Standard & Poor's 500 because it's the broadest of all markets. And the market has been anywhere within the last 4 months between 4,000 high on September 2nd and yesterday at 3,963. So there hasn't been much change there. Another tool that the economist uses called the ISM PMI. It is the Institute of Supply Managers and Purchasing Managers Index. Don't turn off the channel. Wait, I'm explaining this to you, and it's not that difficult. The PMI. Think of them as people who have some insight into what people are going to be doing in the future economically. These are purchasing managers. Purchasing managers have to plan out months ahead for things like labor, sales, inventory, logistics. So they're a really good source to get a flavor from for what the economy may look like down the road. The ISM polls 400 purchasing managers in many different diversified fields. And the feedback they get back to them tells you what companies are going to be doing in the future as far as unemployment or employment and purchasing items. The ideal number is somewhere in the 60s. The number right now is 50.20. And since July, it's been dropping steadily. This is not a good thing, okay? Because it's telling us that 6 months down the line, purchasing managers may feel different about where we are than we are today. So let's move on to another thing that you may have heard, and economists use this, and this is called the yield curve conversion. I don't want to take you back to high school math, but basically, without going to what a yield curve is and doing high school math, what this tells you is when the yield curve inversion occurs, when people are looking at greater gains in short-term investments than long-term investments, that's a problem. What happens is investors can buy bonds, they can buy bills, or they can buy notes. These are federal, I should say, these are bonds that are issued. But if people tend to buy short-term bonds, 2 years, or short-term notes, and hesitate to buy 30-year bonds, that sends a signal like the ISM does with their purchasing managers to economists. It's telling them that people don't have confidence in the economy 30 years down the road, but they have confidence 2 years down the road. And what the yield curve inversion would be that you would get more for investing for 2 years than you would for 30. That is a very serious problem, and that's been going on for a long time. We expect to hear for unemployment on Friday, as I said. I expect it to go up. Let's talk about a couple of things that are going on right now. And we have, as I said, we talked about the PMI. The PMI is getting lower. There's a potential for a railroad strike. It's very possible. The president has decided to do a loan forbearance extension, which is until June 2022. Although he said in September COVID was over, he's still doing an extension at the cost of $10 billion a month for the American taxpayer. The Ukraine war is still going on. Unemployment 3.7. I expect that to rise. The inflation rate dropped a little bit to 7.7 in October, as opposed to 8.2. The next report on that will be in December 13, 2022. We have a lack of diesel oil. And that's a serious problem, particularly with a potential for freight strike, which I may have or will be talking about. And we don't even have enough drivers to drive trucks if there's a freight strike. The U.S. has decided to go to Venezuela to produce oil for us through Chevron. The strategic oil or petroleum reserve is empty, and the president states he's going to buy it back at $68 to $72 a barrel, but that is futures. That's futures trading. We never know if and when that would happen. Strong dollar. I did an essay on that, a video essay on that. The FTX failure. The crypto, what would you call it? Collapse is going on now. Alameda and FTX, as we talked about, they estimate have lost $3.7 trillion. The Chinese COVID lockdown is putting all kinds of problems in the world economy. We're still waiting for to resolve supply chain problem. Irrespective of a rail strike, there are a number of items. I mean, farming has not been that good this year in America. I mean, potato crops are down, peaches, oats, ground beef, even medicines are down. So that's pretty much at 10,000 feet the view in the beginning of December 2022 on our economy. Again, I engage you to subscribe. I engage you to like. And I engage you to follow on whatever medium you're seeing me on. And I wish you to have a great day. Bye.